Most people think of inflation as a fixed thing. Like, oh, we have inflation or we don't have inflation. But really you need a descriptor on there. What kind of inflation? Is it monetary inflation? Is it price inflation? Is it asset inflation? But if I'm a normal red-blooded American, I'm spending most of my stuff at the store. That inflation is up 100% after COVID. It's not 23. Investing is both easy and hard. And the best way to be successful at investing is to understand fully how to be a good investor.
I'm chatting with Kirk Chisholm, a wealth manager expert in alternative investments, held in a self-directed IRA, podcast host, inflation geek. So Kirk, thank you very much for joining me.
Yeah, thanks for inviting me on the show. This will be fun.
Okay, what do you mean by an expert in alternative investments?
Yeah, so let's start by kind of defining the term. And the reason I want to start there is because everyone defines it differently. So alternative investments, if you talk to a Wall Street person, they're going to include alternative investments as anything other than stocks, bonds, mutual funds. So, and traditional buy and hold mutual funds. So what's happened is alternatives about 20 years ago started to make a lot of progress and people were starting to get interested in them. And then Wall Street saw the trend and jumped on it and they said, oh, let's jump on the bandwagon. So what they decided to do was call a mutual fund, which was not buy and hold stocks, as an alternative. Like a long short or something like that, they would, or even using options, they would call that an alternative. I don't call that alternative. That's an alternative strategy, not an alternative asset. And those are two different things. So the term alternative asset, I would characterize it as anything that's not a securitized asset. So not a security, so not a stock, a bond, or a mutual fund.
Would real estate be part of?
Yes, real estate would be considered alternative. Pretty much anything outside the stock or bond markets is alternative, in my opinion. Now, there are some things that are borderline, but in general, that's kind of a good framework to consider.
Okay. And what do you mean by being an inflation geek? So you watch the Federal Reserve a lot. What do you mean by that?
So there were. So let's take it back a little bit. So if you go back in history, inflation is actually kind of a fascinating thing. Now, inflation started because, well, inflation, let's characterize it this way. There's inflation, there's deflation, there's stagflation, which is another term that people, and then there's disinflation. Now, most people think of inflation as a fixed thing. Like, oh, we have inflation or we don't have inflation. But really you need a descriptor on there. What kind of inflation? Is it monetary inflation? Is it price inflation? Is it asset inflation? Like, you have to put a descriptor on it, because if you don't, it's just this vague term that people throw around that doesn't really have much meaning. And what they really mean is the CPI. Well, I don't know about you, but I remember COVID. My inflation was not 23%, as they stated, over a few years. It was more like 100%. And so I don't think the CPI accurately reflected my expenses or anybody else I know. So was it accurate? In my opinion, no. Now, so if you go back in the 70s was stagflationary, which means the economy wasn't growing, but yet you had high inflation. And in the early 80s, once Volcker squashed inflation, or really high inflation, it was, some people call it hyperinflation. It's not hyperinflation. That's very different. High inflation is what we had in the 70s, where you're getting like 20% rates in bonds. I would love that today, but at that time you didn't know if they'd be able to pay them off. That was the risk. But at that point, up until about 2022, bond prices went up and yields went down. So it's been not deflationary, but disinflationary since that time. And there was a period from about 2010 till about, I would say maybe 2000 and right before COVID, say 18, 19, where I would say even COVID, where I would argue we had deflation. Now the Federal Reserve said we had inflation, it was low, but it was, it was constant. But I geeked out on it because I was looking at this saying, this doesn't make any sense. How is this inflationary? Like you're saying there's inflation, but I'm not seeing it. They're printing tons of money, but asset prices are going up, but prices at the store aren't going up. So what's going on? So I kind of geeked out on it because nothing was making sense. So I really dug into the weeds, and what I realized was that what basically happened is in the past, inflation was broadly accepted. Like you had inflation, it affected everything equally. But in early 2000, especially after 2008, the Federal Reserve engaged in monetary inflation, or yeah, monetary inflation. So basically, what happened is in 2000, the tech bubble burst. So what they do? They use the real estate market to kick asset prices into gear, and they started using what they call the wealth effect. Now, the wealth effect is when everyone feels wealthy, so they start spending money, which kickstarts the economy. So it's this reinforcement loop. And that's worked. It worked in the early 2000s, got people spending. Hey, I got all this money. My real estate's going up. I'm feeling good. And then the real estate bubble blew up. The whole world imploded. And then people felt poor again. Well, what do you do now? Well, let's reinflate the world by we're going to do quantitative easing, is what they called it, which is basically asset price inflation. Now, did people get richer? Maybe a little bit. But did their assets go up? Yes, they did. So asset price inflation was significant from March of 2009 until today. It's been really significant. I think the S&P was 666, I think was the low, oddly enough. And today we're looking at the S&P, and it's trading around. It's trading around 66.85. So you're up tenfold. That's a big, significant inflation of assets. Now, have prices gone up tenfold? No, they haven't. So you need to be able to disintermediate assets and consumer good prices and services. So you need to be able to look at all that and come to a conclusion of what does this mean for me? Because everybody's rate of inflation is different. If the rate of college inflation of college prices is 20% a year, that only affects me if my kids are going to college. Because otherwise, it doesn't matter.
So it depends on, your lifestyle depends on what you spend your money on.
Correct. Right. And everyone's different. Right. You can ballpark what it should be. But if I'm a normal red-blooded American, I'm spending most of my stuff at the store, most of my money at the store, and that inflation is up 100% after COVID. It's not 23. I mean, eggs were up a few 100% at one point and then came down. So what's fascinated me about inflation is for the period leading up to COVID, about 10 years leading up to COVID, it was fascinating because you look at all the numbers and you're coming to different conclusions than what was actually being proposed publicly and what everyone thought inflation was. My conclusion was we had deflation for many of those years. No, it wasn't significant deflation, it was borderline, but maybe negative 1% depending on the goods, but it was deflationary. Now here's the problem. So prior to the Fed, and actually prior to 1955, I think it was, we had inflation and deflation somewhat regularly. After that, we've really never had deflation other than 2008, which that was short. But other than that, we really have not had deflation. So the Fed has quote unquote squashed deflation, but they're afraid of deflation. So the reason inflation's I keep using air quotes important in their mind is because our whole economy and financial system is based around inflation. So think of it this way. If we have zero inflation, and we have it for 10 years, so everyone's used to there is no inflation, what's your incentive to spend your money? There isn't any. There's no
incentive to save money.
Right. There's incentive to save money, but there's no incentive to spend it because it's going to be worth the same tomorrow as it is today. So just buy it tomorrow, right? And so the wheels of the economic engine slow down because you don't need to spend your money. But when you have inflation, it stimulates the economy because it forces people to spend. Why do you have a mortgage on your home? Because every year it's worth less. In 30 years, if you just paid interest only, your mortgage would be worth very little in in today's dollars. So the idea is inflation reduces the value of your debt and increases the value of your assets. So it rewards leverage, but it also rewards businesses spending money, because if you hold on to your dollars for a year, they're going to be worth 3% less next year. Well, I can't do that, so I might as well spend it. So everyone spends their money because of inflation. Deflation, it rewards the opposite. Deflation rewards saving money, because all the assets decline in price in deflation, but cash stays the same. So if you have deflation, cash is extremely valuable. It's one of the only assets that is going to be stable. When you have inflation, cash is the worst asset, so everything else is better. So understanding the context is really helpful. Now,
So are you looking at all of this from the lens of an Austrian economist?
I'm in favor of Austrian economics, but I don't like putting myself in a box, because I think that all theories have flaws, right? If you're a libertarian, you believe in little or no government. Well, in some ways I agree with that, but in some ways I know we need someone overseeing other people, or somebody's going to come into my house and steal something, right? And then there's no way for me to get that stuff back. So there is it's a necessary evil, if you will. Like, some things are necessary. So I wouldn't say I'm flat out a belief of one group of theories or another, but I do like most of what the Austrians say.
Because, like, from the Austrians' point of view, inflation is inflating the money supply. It's not prices going up. It's inflating the money supply, and then as a result, it might result in increases in prices.
So here's the trick. So yes, you're correct in theory. In practice, that's not really what happened. So if you look at quantitative easing, what happened? Well, people said, well, they're printing money. Did they? Did they print money? Because I didn't see it. You didn't see it. Did they print it? Let me give you an example. Let's say I'm the head of the Federal Reserve, and let's say I decide I'm going to print $100 quadrillion to stimulate the economy. And what I'm going to do is I'm going to take that cash, I'm going to stick it in the bank vault. I'm going to leave it there. Now, technically, the money supply has increased because we created the money. Do we have inflation?
No.
No. It exists, but we didn't create inflation because it's not circulating in the economy, right? You
Right,
know,
the velocity, right? The
the
velocity
of money, right? So the velocity of money, there needs to be a velocity of money. Now, if you noticed, the velocity of money has fallen off a cliff over the last 10 or 15 years. It's kept going down. In COVID, it really fell off and then it came back. So it's still on the negative trajectory. So that means things are slowing down. Does it? Or does it mean that there's more money, but people aren't spending more? So the net result, I mean, really what you're looking at is the velocity of money times money supply. And if you really look at it, we're not in the place people think they are. So I'll give you an example of what I mean. So from pretty much 2009 until, I guess technically they announced it in 2008, but 2009 until the early 2022, before they started raising rates, the Fed was doing quantitative easing, and which everybody deemed as printing money. But yet the inflation of goods and services really didn't go up. Maybe a little bit, but not as much as you'd think, because they were printing a lot of money. But my prices didn't go up at the store. The price of assets went up, but not significantly. They printed a lot of money. This is not little, right? They tripled, they doubled the money supply like every 8 years or something like that. I mean, that's not insignificant. My prices didn't go up that much. So did we have inflation? Well, I would argue we didn't. Now, a traditional economist might say, well, printing money equals inflation. Well, correct, in the traditional economics and the academic sense. But did we see it? And my argument is no, we didn't see it. Now, what happened in COVID? They took the cash machine and gave everybody piles of money. What do we see after that? At my stores, 100% inflation. They inflated goods and services 100% from prior to COVID. Now, did my assets go up 100%? I don't know. I have to look, maybe. But what's more important is not the asset prices, it's what you pay for every day. That went up a lot, certainly a lot more than the CPI. So my deduction, because my sentiment is the economic system is broken and has been for some time. You know, we don't have traditional capitalism. We've got some Frankenstein's monster version. But here's what I think. None of us can really know, but here's what I surmise based on evidence: is that when you give cash out to the people, you get price and you get goods and services inflation. When you do this quantitative easing, it helps with the wealth effect, but everybody else is not getting richer unless you own assets. But they're also not seeing the high inflation that everybody else saw. So these people would say it's printing money. I would argue it wasn't, because it wasn't circulating in society. It was just stuck in a bank vault somewhere in some, bank's balance sheets, but it wasn't helping you and I and Joe and Susie public. So that, I think, is the difference that people need to understand is the inflation the part that is a problem for us, or is it asset inflation, or what type of inflation are we talking about? That's why I geeked out on it, because things stopped making sense. They make sense to me now that I've studied it, but I think most people are just stuck in the old way of thinking.
Mm-hmm. Let's talk about self-directed IRAs, because you put alternative investments into those self-directed IRAs. So explain this to the listeners. How does it work?
Yeah, so self-directed IRA is another one of those terms that needs to be defined quickly. So a self-directed IRA is every IRA you have is self-directed, just by the construct of the legislation. Every IRA is an individual retirement account. It is self-directed. Now, the term self-directed IRA, like a Schwab will use it, a Fidelity use it. I would ignore that, because the term self-directed IRA, what it means by the sense of most people in the industry, is it means you're investing in alternatives inside your retirement account. So non-securities. So you can't do this through your Fidelities, your Schwabs, your Merrills. They won't do this because they are not constructed to invest in rental property down the street with your IRA. They can't do it. They're not capable operationally of doing it. They might want to, but they don't want that business, because it's not their bread and butter. So the self-directed IRA is effectively an IRA that is held at a custodian. There's 50 different custodians that do this, that will allow you to invest outside of the markets. Some examples of alternatives might be real estate, or private company stock, farmland.
What about gold?
Physical gold. I mean, you can buy the ETF, or you can buy the physical gold. You can buy precious metals, certain kinds, not all. You can't buy collectibles. You can invest in crypto. You can invest in, cows, tax liens, payday lending. So you can invest in virtually everything. The only thing you can't invest in is you can't invest in collectibles, or S corps, or life insurance on yourself. But virtually everything else you can invest in with your retirement account. So what I like about this is people get really creative, and I've seen some crazy returns. And the more public returns, which everybody, you can look them up yourself. Mitt Romney, when he ran for president, he had, I think, $106 million in his traditional IRA. You don't do that by investing in the S&P 500. It's impossible. He did it through his private equity ventures. Peter Thiel has over $1 billion in his Roth IRA. $1 billion. Because he bought Facebook for pennies a share in his Roth IRA, and now it's worth a lot of money. He's got $1 billion tax-free. Imagine doing that in your Roth IRA. Those are the extreme examples and public examples, but if you look at the government data, there's 314 people who have IRAs bigger than $20 million. Do you want to take a guess at what the average balance of those IRAs are, of those 314 people. Take a wild guess what the average balance is.
2 million.
No, it's above 20. So it's the average of the 314 above 20 million. What do you think? There's I didn't give you a cap. So what do you think the average is?
I have no idea.
257 million is the average balance
No.
of those 314 people. So
Wow.
if the low is 20 million, imagine what the high is. Now I
Wow.
know there's at least $2 billion IRAs. I know one of them because it's public about Peter Thiel, but the other one, I don't know the people, but I know the people who deal with them, and there's over $1 billion. And it's not the only one. There's a few. I just don't know them all. So imagine how you get $1 billion in a retirement account. You can't do it through investing in stocks. You can do it through alternatives because there's some creative things you can do to generate massive wealth in a tax deferred or a tax free manner. That's why I love it. And it's this thing that nobody understands. We're the only advisors in the country that specialize in this. We do it for fun. It's a lot of work, but it's a lot of fun because we get to see some really cool alternatives.
So, is this what innovativewealth.com is?
So Innovative Wealth, or our company's name is Innovative Advisory Group. We are a registered investment advisor, so we are fiduciaries. And we manage wealth for individuals and families. So, we do the traditional financial advisory stuff, but what we're really good at and what we specialize in are a handful of things. Alternatives held in self-directed IRAs. That's our specialty that we founded the firm on. We specialize in helping make money when the market goes up and not losing when it goes down. And we also have a few other areas, one of which being strategic college funding. So spending less on the cost of college, not saving more. So we try to find these niche carve-outs that we can specialize in that no one else is doing, and we focus on that so we can deliver immense value to people in a way that they're not getting elsewhere.
Okay. All right. Well, thank you for that. My final question is, do you have any final thoughts that you would like to share with my listeners?
Yeah, I think the final thought I would leave is this. Investing is both easy and hard. And the best way to be successful at investing is to understand fully how to be a good investor. Now, most people are taught some basic frameworks that give them the basics. Like Warren Buffett says, well, you should just invest in the S&P if you don't know anything. And, in part he's right, but not completely. So the one thing that people don't pay attention to and need to is risk management. It is a topic that some really, really bright institutional portfolio managers, they understand the concept, but they don't understand how to apply it. Everybody assumes that means diversification. Diversification is volatility management, not risk management. Risk management is the permanent impairment of capital. That is what risk is. That means you invest in a company, it goes to zero. That's a permanent impairment of capital. It's not coming back. Volatility management is basically the market's going up 5%, it's going down 10%, goes up 20%. That's volatility management. Most people are doing volatility management, not risk management. So in 2008, virtually everything except for gold and cash was down 58% and change, within a few percentage points. Everything. In the early 2000s, unless you're in value stocks, everything pretty much lost money. In COVID, virtually everything lost money. In 2022, virtually everything lost money. So if you're diversified, it didn't help you because everything you were invested in went down. So is that risk management? No, it's not. And so what people don't understand is they don't understand how to manage risk because they don't put themselves in the scary position of what would happen if this happens? What would happen to my portfolio? People are scared to do it because they don't want to know what they're going to find. So I always tell people we have a value at our firm called risk management first, which is focus on managing risk first, and the performance takes care of itself. The performance is the easy part. But if you don't manage risk, you could be in a position where your portfolio declines 50%. And imagine if your portfolio only declined 5%. Well, now you can buy things at a half price discount. So you can buy twice as much of it. You don't need to outperform every year. As long as you don't miss big, you don't have to outperform every year to outperform the S&P. You just have to pick those few opportunities where everyone loses money and you don't, and you can make a lot of money. So you talked about anti-fragile early in the show. We try to put together resilient portfolios that have an element of anti-fragility to it to make sure that no matter what happens, that you're going to be okay.
Hmm. And how can people find you online?
Yeah, I'm pretty easy to find. You can go to innovativewealth.com. That is our company website. I do a podcast every week, moneytreeinvesting.com. And you can find me on all the socials. I'm everywhere. I put out a lot of stuff. So, if you're looking to learn, we got a lot of videos around YouTube. I'm easy to find.